Hello and welcome to CN Professional Institute. This is part 2 of IAS 19 employee benefits. So in the previous video, we looked at the definition, we covered the scope, and then we looked at types of employee benefits, right? So we picked the short term, we looked at the short term, we looked at termination benefits, we looked at other long-term employee benefits, and then we started with the post-employment what benefit. We said that's the main topic. I mean, that's the main type of employee benefit covered by IES 19, right? And then we said that with the post-employment benefit, we have two types. We have the defined contribution and the defined benefit. So we look at the defined contribution and we solve one example. In this video, we are going to continue with the defined benefit. We look at the defined contribution already, so we continue with the defined benefit and we solve more questions, right? So the main standard is about the defined benefit plan, the defined benefit, which is a type of post-employment benefit, right? So let's continue with the defined benefit. Defined benefits. Okay, so we said with the defined contribution, okay, we said, okay, the entity, okay, pays a fixed or regular amount into a separate fund, okay, managed or controlled by a different entity, right? So we said with the defined contribution, the employer or the employer or the entity pays a fixed contribution to a separate fund. Okay, and we give an example to what's in it. And we said, okay, once the entity is done paying that fixed amount, they don't have any legal or constructive obligation to pay further contribution if the fund is not enough, okay, or if the fund does not hold enough assets to pay the employee benefits when the employee retires or when the employee goes on retirement, right? So we said with the defined contribution, the only obligation is for the employer with the entity to make regular and fixed payment into a separate fund. That's all. Okay. So we said where with the defined contribution, where the employee retires, okay, we said the employee does not go back to the company where he or she works for him or her to ask for the benefits for the retirement, for the SNP contribution, okay, or for the social security contribution. You don't go back to the entity or the company, but rather you go to the separate um fund. I mean, you go to, let's say, SNP, okay, where the contribution has been made on your behalf. You go there and then they will sort you out. So it's the responsibility of the third party now to take care of what the employee, to pay the employee benefit, okay, or to pay your senate when you go on retirement. And therefore, the entity has no obligation whatsoever again towards you. Okay, so we said that's the defined contribution. So once the entity or the company is done paying your social security, yeah, once they are done or when they are done paying, okay, into that separate fund, into that separate entity, they don't have any obligation to you again. So now we say when you go on retirement or when you stop working, you have to go to the third party. You have to go to, as example, SNP, and they will look at your or they will pay you. So now it's a responsibility. So we said with that one, the risk or the risk or the responsibility does not lie with the company after they are done paying your contribution. It lies with the third party, right? The defined benefit is the opposite of the defined contribution. So with that one, instead of a fixed and regular payment being made to a third party, okay, the entity themselves, okay, they set up a fund or they create a fund, okay, they create a fund in which all contributions are made into on your behalf. Okay, so we said with the defined contribution, I'm sorry, with the defined benefit plan, let me put everything, let me summarize everything before we continue. So we said with the defined benefit, okay, instead of the company paying your benefits, your Senate contribution, your social security contribution, instead of the company paying to a separate entity or a third party, the company themselves, they will have their own fund. Okay, they have their own fund, or maybe they will have their own insurance company, and payment is not made to a third party. Let's say payment is not made to Senate or a third party. Payment is done into the own fund by the entity, by the company. Okay, so payment is made to their own fund or the entity or the company's own fund, and then when the employer, when the employee retires or when the employee go on retirement, okay, the employee doesn't go to a third party, but rather the entity is held responsible. It's the entity's obligation, the company's obligation to pay the social security contribution or to pay the Senate contribution. It's the company's responsibility to pay the Senate contribution to the employee. So now the risk and the reward, let me say the risk remains with the employer. So it's now the employer's responsibility, okay, the employer's responsibility to pay the Senate contribution. I mean, to pay the post-employment benefit, okay. It's their responsibility to pay the employee when the employee goes on retirement. So any benefits that is due to the employee when the employee goes on retirement is the company's responsibility, not a third party's responsibility, because they've taken it upon themselves to create a fund. They've taken it upon themselves to manage the fund on behalf of what the employee, so that when the employee goes on retirement, they will pay the benefits. They will not go to a third party, or the employee will not go to a third party for the third party to pay the employee. The company will take it upon themselves to pay or take care of the employee or benefits, right? So that's with the defined benefit. So we said with the defined benefit, okay, um, it says the employer guarantees the amount of pension that its employees will receive after they what retire. So after they retire, it is the company's obligation, it's their responsibility, okay, to guarantee the pension that the employees will receive, right? And this a company might save into a separate fund. They create their that's it, they create their own separate fund. Okay. It says just as for the defined contribution, they create their own what fund in order to accumulate or build up an asset that can be used to pay the pensions of employees when they what retire. So in this case, the company creates their own separate fund, okay, and they build assets, they deposit money into it, okay, so that it can end up enough to pay the employees when they retire. If there is sufficient funds in the plan to provide employees, okay, with the guaranteed pensions when the employer, so it says if there is sufficient funds in the plan to provide employees with the guaranteed pensions, then the employer must make up the shortfall. The risk remains with the employer. So we said with the defined contribution, that one the risk remains with what? The third party. It doesn't remain with the employer because the employer has made payment into a separate fund, okay, to be managed by a third party. But here we said the entity themselves, they are creating the fund. So the risk lies with them. If the amount in the fund is not enough, no third party will be held responsible. It's the entity that will be held responsible. Are you following? So the employer will be held what? Responsible. And it says defined benefit plans are often known as final salary schemes. And then these are the two types. So that's it. We'll look at it. Okay. So these are the two types. We'll look at it. But that's what the defined benefit plan is. So we look at the difference between the defined benefits and then the defined contribution. So with the defined contribution, the employer makes fixed contribution to a separate fund. Okay. And then the risk and rewards lies with that third party. And if the money in the fund is not enough, if the fund, the asset is not enough to pay the employee, the entity is not held responsible. Okay, it's the responsibility of the third party. But we said with the defined benefit, the entity creates their own fund. Okay, instead of getting a third party to manage the fund for the employees, they create their own separate fund. They invest in it, and then when employees go on retirement, the entity themselves, the employer themselves, they pay the benefits to the employees. And if there are insufficient funds, the company is held responsible, and the risk remains with what? The employer, right? Okay, we have two main types of defined benefit plan. I will not say type though, but like when you pick the defined benefit, Okay, it has two components. So the defined benefit plan has two what components. We have the defined benefit assets and the defined benefit what obligation. So we have the defined plan assets and then the defined plan what obligation. Okay, so we have the plan assets and then the plan obligation. Now you see, if the entity decides to manage their own fund, create a separate fund where they will manage the fund on behalf of the employees, what they do is they create a separate fund, okay, a fund in which they make payment into, they make the contributions into, so that in the future they can get money from that fund to pay the employees. Okay, that's the plan asset. So with the plan asset, you see that they will have, let's say if they have opening balance in it, they'll be making payment into it, and that fund, okay, will earn interest. It will be earning interest. So in the fund, if we have opening balance in the fund, there will be a top up. Like they will do more contributions into it, that which will increase what the fund, the money in the fund, and then the money in the fund will also earn interest. I follow it. If they want to pay the employees, they go and pick money from that fund. If they want to pay the employee benefits when they retire and then they want to pay their Senate contribution or their pensions, they go to the plan asset and go and take money from the asset to go and pay them. So the plan assets are a fund that they've created where they invest. Okay, they invest and then they earn interest on it. The defined benefit obligation here is the present value. It's like the liability. They estimate the amount that they'll be paying their employees in the future. Are you following? So that's the liability. So they estimate it, and it's normally done by the actuaries. So actuaries do that. They estimate the liability that they'll be paying in the future. Okay. Then they discount it to present value and they do unwounding. So if it is discounted to present value, every year they compute the finance interest on it, the finance cost on it. And then also when they pay employees, when they pay their pension, it will reduce the obligation. Okay, so we'll take them one by one: the defined benefit plan asset and the defined benefit plan obligation. Okay, so let's pick them and look at it. What in them? Okay, so let me come here before we go there. So this is the defined benefit plan asset. The defined benefit plan asset. So this is how it looks like. Okay, so we have what we call the fair value of the plan asset brought forward. So if the entity creates the fund, okay, do they have any opening balance in the fund? If the fund was created like 2 years ago, 3 years ago, until now, they will have some opening balance in the fund. I getting it. They will compute what we call the interest income. The interest income is the rate, okay, that's the interest, I mean the rate of interest, the income earned on the investment, that's the interest income. So normally a percentage which is applied on what? The basically the opening balance. Okay, so the interest income. So if you have an investment and you have an amount of money into that investment, you have an amount of money in that investment or in that fund, okay, that investment or that amount of money will earn interest income. I following. So the interest income is normally a percentage of or a percentage earned on the money in the fund. Okay, so we compute interest on it and we'll add it to the balance in the pool, the balance in the fund. Because like bank account, you have a bank account. If you have money in the bank account at the end of the period, okay, you earn interest income, which is added to the amount you have. Okay, so interest income is computed normally a rate or a percentage on the opening balance and it is added to the plan asset. Then we have contribution to the plan. So payment into the plan. So the entity will also be making payments into the plan. So we said instead of with a defined benefit, instead of the entity making payment to a third party, they create their own asset, they create their own fund, and they pay into the fund. So payment into the fund by the entity will also increase the asset in the fund. So you have bank account, you have added money, you are making payment into your bank account. It will increase your bank account, and the benefit paid out of the fund will reduce the fund. So as they are making payments to the employees, as they are paying their benefits, as they are paying the pension, they take money from the assets, from the investment, they take money from the fund, okay, from the account, the fund that they have, they take money from the fund. So benefit paid out of the fund will reduce the what? The amount in the fund. Okay, so it will reduce the plan asset. Okay, and then we have the closing balance here, fair value of plan asset. This fair value of plan asset is done by actuaries. So I'm saying actuaries estimate the what? The fair value of the plan. Okay, as at the year end. So the difference between the summation of all this and the closing balance is what we call the remeasurement loss or gain. So you add your opening balance, add the interest income, then we add the contributions into the plan because we said that will increase the plan. Then you less benefit paid. You get an amount. Come and compare that amount with this opening balance. Come and compare it with this what? Sorry, come and compare with this closing balance. The difference is the remeasurement loss or gain. I following, which is recorded in other comprehensive income OCI. So I'm saying the closing balance here is normally given the question is done by actuaries. The opening and the closing is normally done by actuaries and it is given in the question. So that's how the plan asset works. Then let's look at the plan obligation define. So this one here is the defined benefit obligation or the defined benefit plan obligation. So we said with obligation, okay, actuaries they estimate the amount you pay in the future and it is discounted to present value. Okay, now when the amount is discounted to present value, you see, whenever we discount an amount to present value, we have something called finance cost. We have to unwound. So when we discount it to present value and we have present value of the defined benefit obligation brought forward, we calculate interest on it, we unwound it, so we apply the finance cost, the interest rate on the opening, and that gives us what? Interest cost. And so it's an expense which we record in the P&L. Then we have something called service cost. We'll look at all these things in details. The meaning is there. I want to introduce you to the format. Something called the service cost. Service cost is the increase, okay, in your defined benefit obligation, either in the current year or as a result of some past stuff. So we'll look at it. You see, the more people you employ, the more payment you have to make into the fund. Okay, so the more people you employ, the more your liability increases. Because the more people you employ, the more future pension you pay. Okay, so we'll look at service cost. We have it there in the slide, the definition. We'll look at more into the types of service cost, the current service cost and the past. We have some components like curtailment and then amendment. We'll look at more about service cost. But just know that service cost will increase your defined benefit obligation, so we'll add it. Benefit paid will reduce your defined benefit obligation because when you pay pension, the more pension you pay, your liability reduces. Okay, let's say you have a pension plan for like 20 people. You've paid 3 people, you've paid 4 people. As you are paying them, the liability what reduces. So we have to less the benefit paid to them. Okay, so benefit paid to your pension paid to the employees, it reduces the obligation and it also reduces your asset because we take the money from the defined benefit asset. We take money from the investment, the fund that you've created to pay your employees in the future. We pick money from them to come in from that fund to come and pay the workers, the employees. So it reduces. So benefit paid reduces both the asset, the plan asset, and also reduce your liability, the obligation. Okay. So again, the same thing here. We have present value of defined benefit obligation. The closing. This one is a closing figure. Okay. So what you do is bring the opening, add interest, the interest cost, add the service cost, less the benefit paid out. The amount you get, come and compare with the closing balance here. And the difference is what we call the remeasurement loss or gain, which also goes to other comprehensive income. So this is the format for the defined benefit obligation. We have the net where we combine both the assets, the defined benefit asset and the defined benefit obligation together, right? So this is the format of the defined benefit obligation. So when we come here, it says accounting for defined benefit plans. So it says an actuary calculates the amount to be paid, which we said that. So actually they estimate both the closing balance and then the opening balance. They do estimation. Then calculations are based on estimates and assumptions. Example, life expectancy, return on investment, wage inflation, and employee turnover. So it says, okay, to estimate the amount of liability we pay in the future, the defined benefit obligation, the amount of pension paid in the future. We said actuaries do that, and they base the assumption on so many things like life expectancy. So they estimate the life of the employee, because when you go on retirement and you start receiving your pension, okay, it will be up to a period. Let's say you go on retirement 60, so they can estimate that okay, you will live by let's say 90 or 100. So from the time you go on the retirement 60, they will pay you for like 40 years. Okay, so they factor in all these things when they are doing their computation. Okay, and I'm saying the defined benefit obligation and then the defined benefit asset, the values, the opening and closing is always given a question. Okay, I said it's done by actuaries, so actuaries do that. Okay, and they base their assumptions on this: the life expectancy, how long will you live after you go on retirement, and then the return on investment. If they go and invest the amount, the money, how much will they get? The return they get. Okay, because we said the entity creates with the defined benefit plan, the entity creates they create a fund and they manage the fund themselves. So how much would they get from that fund, from that investment? Okay, and then wage inflation, how much would the wage increase? And then employees turnover. Employees turnover means the rate at which employees come and leave the entity. So they factor in all these things when they are computing their values. Okay, when the actuaries are estimating, when the actuaries are estimating their what, the present value of the defined obligation, both at the opening and at the end, right? And this is if liability exceeds the asset, okay, we have deficit and therefore liability in the statement of financial position. Now, what we are saying is that, okay, we'll solve more questions and you get it. What we are saying, okay, we have two things. We said we have the defined benefit plan asset and we have the defined benefit plan obligation. So it says we compare the asset with the liability. We compare the plan asset with the plan obligation. If the asset exceeds, if the plan asset exceeds the plan obligation, then there's a deficit, which is like net liability because the liability is more than the asset. So we have what we call deficit or net liability, which will be recorded as liability in the statement of financial position. On the other hand, if the asset exceeds the liability, it is net asset, which will be recorded as what? Asset in the statement of financial position. So we can compare the opening plan asset with the opening plan what? Liability or the plan obligation and see if we have net deficit or net what? Asset. When the liability exceeds the asset, it becomes deficit or net liability. And if the asset exceeds the liability, it becomes what? Let's say in a way surplus or net asset, which will be recorded asset in the same of financial position. So we look at all this. So you're just saying you compare your plan asset to your plan liability and you record deficit or asset, you record obligation or asset, right? And then say liability measured at present value of defined benefit obligation using the projected unit method. And I'm saying all these things are not done by accountants. Okay, if they are done by the actuaries, so they do the estimation. So they find the present value of your obligation. Okay. So the obligation is measured at the present value, while the asset is measured at what? Fair value. You measure the asset at what? Fair value. Okay. So that's it. We'll look at more into it. As we solve questions, you get to understand what better. Right. So that's the format. Now let's solve one question. Okay. Let's solve one question. Let's see how the defined plan asset works and then the defined plan what? Liability. Let's see how it works. When we are done, we'll come and explain the components and then we'll pick a whole question where we even involve the net. There's a net method here, but we'll look at the net um along the line. But now let's solve this question. The following information relates to the defined benefit plan of CN for the year to 31st December 2x6. Okay, or let's say 2016 for the year ended 31st December 2016. Okay, very good. So this 2016, we have at 30 at 1st January 2016, we have fair value of plan assets, present value of plan obligations. We said the fair value is the asset is at fair value, and then the obligation, the plan obligation is at what? Present value. So we'll be giving the opening balances for both the asset and what? The liability. During 2016, these are the things that happened. Service cost 90, contributions into the plan. I'm saying we'll look at more, we'll look at this into details, the definition of service cost and the treatment, contributions. I just presented the format to you. Let's pick the figures, plug in the figures and see the format. Then we'll go and look at the detailed explanation of the components, and then we'll solve more questions for better understanding. Okay. Then we have payments or benefit paid out of the plan. We have actuary what actual assumptions. Discount is what 10%. Then we have new actuarial valuation at 31st December 2016. So these are the closing balances. The fair value of plan asset 850, present value of plan obligations what 1,960. And it says we should prepare the extract of the statement of profit or loss and statement of financial position. Okay, so let's do them one by one. So let's do the defined benefit um asset or the defined benefit plan asset. So let's do the asset. When we are done with the asset, we'll come and do the liability obligation and we'll see the net. Okay, so let's do the asset. Let's do the asset. Then when we are done with the asset, we'll come and do the liability. Okay, we will come and do the liability. Okay, so with the plan asset, okay, with the plan asset, if you look at the formula or the format that we used, okay, if you look at the format or the formula that we use here, okay, let me take you back to that place there. So see, this is the asset. We say we bring the what the fair value of the asset at the beginning, then we add the interest income because interest income will increase it. Then contribution to the fund will increase it. By making payment to the fund will increase. Benefit paid out will reduce it because we are paying employees. So we go and take the money from the asset, from our investment, from our account to go and pay them. So it will reduce it, right? And we do it. So this is it. That's the same thing we are going to do here. So when we come back to the question here, so we start with our defined benefit asset. So our defined benefit what asset. Okay, then we have three zeros up. So I'm working with three zeros. Okay, so you can put the three zeros up as we work with it. So we said we have to pick the opening balance. Okay, we bring the opening balance. Okay, the opening balance, which is the fair value of the plan asset at the beginning. Fair value of plan asset at the beginning. If you check at the beginning, what's the asset? 900. So this, in a way, like an amount we have in our bank account or the investment, the pool. Okay, the amount we're having in the investment. So we are doing the plan asset. Then we said the opening balance will earn interest. Okay, it will earn interest. So we have to compute interest income on it. I'll explain more to it. Now, the opening balance will be in the fund for the whole year. So it earns interest. Normally, contributions into the fund and payment into the fund are normally made at the end of the year, right? So they don't really affect the interest. But where the contribution and payment into the contribution to the fund is done at the beginning, you realize that the contribution to the fund will also earn interest. And so in that case, we'll charge interest on it. Okay, where the contribution to the plan is made at the beginning, it will earn interest. But if it's done at the end, it doesn't earn any interest because the year has ended. So here, the assumption that the contributions into the plan and the payment out of the plan are made at the end. So it is only the opening that will earn what? Interest. But we'll solve complex questions where payment into the plan is not done at the end. Okay, it's done at the beginning or midway, and therefore they will earn interest. The payment to the plan was to earn what? Interest. We'll look at those ones, right? So 10% of 90 900 will give us what? 90. So that's our interest income, and it's an income. Okay, and we said if you check the format, the next part, the next thing here is to look at, where is it? Okay, it's here. So after then contribution to what? The plan. So contribution to the plan. So this contribution into the plan. Okay, How much have we contributed into the plan? If you come back to the question here, it's here. 2016 contribution paid into the plan is 150. So we paid 150 into the plan. So we put what? 150 into the plan. And then benefit paid out. If you come here, okay, after the contribution to the plan, we have benefit paid out. Okay. So I'm coming in. Let me. Okay. So we have here, if you come here, we have benefits paid out. Here, benefits paid out. So when you pay, it reduces your, so we say benefit paid out will reduce the plan asset because we are going to pick money from the asset from the fund to pay the employee. So benefit paid reduces the amount. Okay, it reduces the amount in the fund. So benefit paid, how much the benefit paid? It's here. Benefit paid out by the plan 60. So we less our 60. We less what? The 60. Are you following? So that's it. Then we said when you get to this place here, so we brought the opening balance, we brought the interest income, which is 10% on the opening, contribution to the plan 150, we've added benefit paid out, we've deducted. Then we said what you do is you add or come and check the closing figure. Come and check the closing figure given to us. We are looking at only the asset here. Fair value of plan asset. This is the closing figure, 850, right? So the closing is what? Let's bring the closing here. The closing balance is what? 850. Are you following? Now, so let's bring that 8 what? 50. Now, check. We said the difference between all these things that we've done here and the closing balance is what we call the remeasurement loss or gain, which we take to OCI. So let's add 90 plus 900. That's the opening. The opening is 900 plus 90. Okay, so 900 plus what? 90 plus 150 minus 60. I got 1000 and what? 80. I got 1000 and what? 80. Right? So if you do it this way, you get 1000 and what? 80. Right? But look at the closing balance. Look at the closing balance. We're told the closing balance is what? 850. Are you following? So minus 850. If you compare, you get a difference of what? 230. So your plan asset, after you are done adding, we got what? 1000 and what? 80. We got 1000 and what? 80. That's when we're done adding, or we got 1000 and what? 80, right? Now, the closing balance is what? 850. So can you realize that our asset has reduced? Because after adding, we got 1000 and what? 80. But now the closing is what? 850. So after adding, you realize that our asset has what? Reduced. And when asset has reduced, right? What is it? It's a loss. Are you following? So we have a remeasurement loss of what? The difference. So we have something called remeasurement loss. So you have to write it in full. Remeasurement what? Loss. So here's a loss. Why? I'm saying our asset has reduced by what? 230. So it's a remeasurement what? Loss. So I'm saying you just do it and compare with the balance and the remeasurement loss. And I told you the balance will always be given to you in the question, the closing balance. We said those ones are actuaries do that. They do the estimation. Okay. So when you do it, you get a closing balance of what? 850. Right? So the difference is what we are going to record as our measurement loss. And I'm saying it's a loss because this one means an asset has reduced. If an asset has reduced, it's a loss. I'm saying again, if you add the 900 to 90, then you add 150 and you less 60, you get 1000 and what? 80. But they are saying, the actuaries are saying the closing balance is not 1080, it is 850. So the difference is 230. and the 230 means your asset has reduced by 230. So it's a loss. If the asset has gone up, okay, then it would have been what? A remeasurement gain. So be very careful. If after getting our 1,080, the actuaries are saying our closing balance is what? 2,000. Okay, then asset has increased, so it's a remeasurement gain. But here the asset has reduced, so it's a remeasurement what? Loss. So that's all. If you go to the P&L account, the extract, if you are doing extract, okay, you record this interest as income in the P&L account. You record this remeasurement loss here in OCI, and your closing assets, statement of financial position, non-current asset 850. So you let's do the extract, okay, so that you have a look at it. So let's do the extract and we'll do the liability and then we'll pause. So let's do the extract for the P&L. Okay, so let's just write the P&L. Okay, so we said in the P&L we are going to have, so you can just label it well. So the P&L, I'm just doing the extract. Okay, in the P&L we are going to record interest income. Okay, so we have interest income of how much, which is income, which will go to other income 90. Okay, then when you go to your OCI, other component of other comprehensive income, OCI, we are going to record the remeasurement loss. Are you following? So we are going to record the remeasurement loss. How much is the remeasurement loss? We have remeasurement loss of what? 230. 230. And then when you go to your statement of financial position, okay, when you go to your statement of financial position, we are going to record a non-current asset. Don't forget non-current asset. So non-current asset. Okay. And under the non-current assets, we have defined benefit asset. So we record our defined, okay, defined benefit asset. It's a current asset. How much? The closing figure, the 850. The 850. So this is how we are going to record. We said we record the interest income in P&L, remeasurement loss in OCI, and then the closing figure as an asset. Let's go and do the liability and see how it works. Let's go and do the liability, the defined benefit liability or obligation. So the defined benefit or obligation. That one's the same. We bring the opening balance. Okay. So we start with the opening balance. How much is the opening balance? So we come here. 1016 present value of plan obligation is 1,000 and what? 850. That's the opening balance. Okay, 1,000 and what? 850. That's the opening balance. Then we said we will bring the interest. Okay, we have to unwound. So there will be interest income. I'm sorry, interest expense. Okay, the asset give us interest income. This will give us interest expense because a liability and we are unwounding it. So interest expense of how much, which is apply the 10%, that's the rate, 10% on the what? The opening balance. We are giving the rate here, the discount rate is 10%, the interest 10%. So 10% on the the opening balance. So yeah, we used to put the 10% for the interest and the expense. Sometimes they give you different rates. They tell the discount rate is 10% and the interest they will earn from the investment, okay, is let's say 20%. The interest from the investment is what we use in the plan assets. Okay, but here we have only one rate. So we use both the interest, we use the discount rate for both the interest expense and the interest income. So 10% on the opening balance here will give us what? 185. And we are adding it because we said that will increase the opening balance. Then if you come and check the liability here, the obligation. So we have interest cost, then we have service cost. Okay. And we said we'll look at it. But service cost is just the increase in what? The present value of the liability. It increased the liability, so we add. So we have current service cost. Okay, so I said we'll look at more at that service cost. What's our service cost? The service cost is 90. So we'll add the service cost 90. Okay, then we have benefit paid out. It's also in the format. So we said benefit paid out reduce. We said benefit paid out reduces the what? The liability. Benefit paid. Why? Because as you are paying them, you are reducing your liability. Your obligation is reducing. Okay, so if you pay 4 people out of, let's say, 20, your obligation is reducing. So your obligation reduces. So we have to deduct. How much is it? Benefit paid out by the plan 60. So we have to reduce, we have to less the 60, right? And then we've been given a closing figure. What's the closing obligation? That's the closing balance. So in the question, check. If you come here, the closing balance is what? Of the liability is 1,960. 1,900 and what? 60. So let's check something. Let's add or and compare. Okay. So the opening is 1,850 plus 185 plus 90 minus 60. If you deduct, okay, let me do the figures again. So we have 1,850 plus 185 plus 90. Okay, then minus 60. What do you have? I have 2,065. 2,065. That's after doing this plus this minus this. I have 2,065. So this is a liability per what we have what calculated. But the actuary is saying that okay, the closing liability is what? 1960. Okay, so when you compare 1960 with what we've gotten from us, our liability is what? 2,065. But the actuary is saying it is 1,960. So can you see that our defined benefit obligation liability has reduced? The defined benefit obligation liability has what? Reduced, right? So if it has reduced, then it is what? A gain. If liability reduces, is what? A gain. So here it is remeasurement gain. Are you following? The asset was a remeasurement loss. So here you can write full remeasurement what? Gain. Why is it a gain? If your liability reduces, it's a gain. Okay, so we just have to compare the 2,065 with the 1960. So 1960 and have 105. 105. So this 105 here is a remeasurement gain. Now I'm going to less it. Why? Because this is a liability. It's the same thing. You can decide to leave it like that. But I will less it because what we are doing liabilities, define benefit what obligation, and have a remeasurement gain. So I expect the remeasurement gain to reduce my obligation. Are you following? So that if you reduce, okay, so you do it. If you do it, this figure plus this minus this minus the remeasurement gain, you come and get the this what we are saying, or this what it means. You see, we have opening balance of 1,850 interest expense. So we said add the opening balance, add interest expense, add service cost, less benefit paid out. Right? When you do all this, you get 2,065. Okay, when you add all and you less the benefit paid out, you get 2,065. Then that 2,065 is something called the expected value. Okay, then go and compare with the closing. So the expected value is 2,065. Closing is what? 1,960. So you realize that the liability, the defined benefit obligation has reduced. If liability has reduced, it is a gain. Are you following? If liability has reduced, it is a gain. If liability has gone up, it's an expense. When you go to the asset, if asset has gone up, if asset has increased, it is a gain. Your asset has gone up. It's a gain. Your asset has reduced. It's an expense. So watch out and then get the link. If liability has gone up, it is an expense. If liability has gone up, it's an expense. If liability has reduced, it's a gain. If asset goes up, it's a gain. If asset reduces, it's an expense. So that's it. So we said when you compare the 2065 with the 1960, the difference is what? 105, which is a gain. And we are lesson because this is a liability, defined benefit obligation is a liability. Okay, so again should reduce your liability. That's why we subtracted it to reduce the what? The liability. Better still for accuracy, arithmetic accuracy. Okay, if you put plus here, you will not get the 1960. Okay, so that's it. It's a liability and it has gone down. I mean, the figure has gone down. We say it's a gain, so you have to less it. Okay, so that's it with this one. Then, if you want to do your P&L, the extract, the same thing. This interest expense is recorded as what? Expense in the P&L account. Service cost also as an expense in the P&L account, right? And the benefit paid will affect our cash. To affect our cash if you want to do it that way. And this remeasurement gain is taken to what? OCI, either comprehensive income. And in the closing balance, we have a closing balance of 1960 as obligation. It's a liability, defined benefit obligation liabilities. So it will be non-current liability, non-current what? Liability in the statement of financial position, non-current liability. Now, there's something we call net, which we'll be looking at. Okay, there's something we call net, which we'll be looking at. You see, you can pick the two. When you come here, the interest, we said when we're doing the liability, the asset, we had interest income of what? 9 million, which we recorded as other income, which we recorded as income, right? So see, this 9 million, we have interest income. When it comes to the interest expense, look at the interest expense. It's what? 1850. So you can just find the net. The interest expense is more than the interest income. So the net will be what? Expense. Are you following? The liability to the same thing. Look at the closing asset. The closing asset 850 here, 850. Are you following? So we had closing asset of what? 850, right? Let's go. If you look at the liability is, if you check the liability is here 1960. So you can use the net. I'm getting it. Compare the asset and the liability and get a net. So look at the net method of doing it, right? So let's end here, or let's pause here. We are going to continue. We have so many things to do. Or we have a lot to do. We'll continue with the component, and then we'll solve questions involving both the individual and the net. Okay, and then when we are done, we look at asset selling. So we have a lot to do. So let's end here, and then I'll see you in part 3 of IAS 19 employee benefits.